my fellow investors. Welcome back to the Newcomer Investor Channel. It is so nice to be back. No, I was not in retirement. I was still here. Truth be told, I have had lots of new changes in my life, all wonderful changes. New work, new commitments, and really last few months, I just put my head down. I had to be extremely focused on all of that, which is why I hadn't dropped an episode in a while, but we're back. The situation made me have to come back. I'm a big proponent of only speaking when you actually have something to say, and I have a couple things to say. But of course, as always, I have to remind everyone that I am not a financial advisor. This is not financial advice. I'm just telling you what I'm doing and my own thought process. But I think you should obviously always also do extra research and consult your own sources and advisors and so on. Okay, now what are we talking about? Well, my friends, we have to start with politics. And now, I know, this is a huge turnoff. This is an investing podcast. Why would anyone be political? No, I don't mean to be political in the partisan sense, but we have to analyze politics now because this is going to play a huge role in the success and failure of many businesses. Now, what has happened since the last episode? We have our neighbors to the south who have elected President Donald Trump, and I think it's safe to say, both for his supporters and detractors, that this presidency, at least in its first couple of months, it has not been what people really expected. It certainly has not been anything close to the first presidency. The attacks on Canada, the tariffs with fentanyl as a reason for it, and then changing his mind constantly, and now the tariffs against the entire world, and then taking them off, and then putting them on China. All of that is horrendous for business. And if it's horrendous for business, obviously, that means it could spell trouble for your stocks. Now, there is a counter-narrative going on that perhaps everything that's happening is a highly elaborate 4D chess game, and that everything is going to be okay, and it's actually going to be even better than it was before, and just wait a couple of months and you'll see type of thing. I personally do not share that assessment. I think that we are now, at least for the next few years, probably in a time when this uncertainty is going to be extremely heightened. And if that's the case, you obviously have to plan your portfolio accordingly. So, how do we do that? Again, this is not advice. This is just my personal thought process going through huge drops and gains that we've seen in the last few weeks. So, number one for me has been don't panic. We have spent, as you know, the last few months of 2024 cutting down on the portfolio. I had up to 50 positions. We're now down to 21, I believe. These are all positions now that I really quite like and that I think are able to withstand quite a lot of things. So don't panic sell for no reason. You own a business, not a little ticker that goes up and down all the time. If you liked the business 3 months ago, you should probably still like it now. Or most likely you would, right? At least that's the case for me. So I did not sell anything when those tariffs hit. Number two is prioritizing resilience. How do you get resilience? One way is diversification. So this is actual real advice now that I've given to some of my friends who've asked, oh, what stock should I buy? But friends who don't spend, all their free time analyzing businesses. I said, if you want to, dollar cost average, let's say put a little amount every month, my recommendation here is probably something like the XEQT ETF. This is a world ETF. As you know, it's my second largest position. With this, you get exposure to, I think, 8,000 or 9,000 stocks. It's going to go up and down for sure, but the risk of it going to zero is very, very low. That would be nuclear war scenario, right? If we don't have a nuclear war, probably not going to have the 8,000 largest global businesses all collapsing at the same time. That's quite unlikely. So XEQT is nice. That's diversification. Another type of diversification, which is the type I have been prioritizing, is having businesses whose revenue sources are diverse and are global. You know, this is a topic I have spoken about at length over the last few months, even years now. I really, really like Brookfield Corporation because they are virtually in, I think 30-ish countries, lots of revenue sources. I also really like Alimentation Couche-Tard. I like Restaurant Brands International. I like Franco-Nevada. I like Fairfax. All of these are in at least 3 continents each, minimum, right? So that gets to insulate you a little bit from all the craziness that's going on. Obviously, every country is likely going to be affected one way or another by tariffs, but if your business gets revenues from lots of different places, at least it reduces that risk and volatility a little bit, right? We're not talking about one company that just depends on one supplier to provide them something and now their costs go up X%. It's not like that. And another big piece is financial resiliency. How's your balance sheet? How much debt do you have, right? Now, my largest holding, Brookfield, is famously full of debt, but at least they've structured it in a pretty smart way with very, lengthy maturities. And it's what we call a non-recourse for most of their assets. Non-recourse meaning that if, the debt is tied to one of their assets, and if there's some kind of issue, they can't pay it back, the creditors can only come after the asset rather than come after everything that Brookfield owns. So that's a good way to structure debt if you have tons of it. But what I prefer is if you have no debt, which is what Franco-Nevada has, for example. That's another one of my top holdings. So if you have companies that are financially resilient, that will also insulate them a little more against these new shocks that we didn't predict, right? My belief is over the next few years, there will be more things coming from Mr. Trump that we did not expect and that are happening, right? So you have to be ready for it. And now, full transparency, what did I buy since Liberation Day? I purchased just small amounts because I think much worse may be coming, unfortunately. So I'm keeping a bit of dry powder, though I'm not even rolling in tons of cash, but the little cash that I have, I'm not deploying all of it. But I bought little amount of EQB. That is, of course, Canada's best bank, in my opinion. I have an episode with one of their executives. Highly recommend watching it. I also bought a little bit of Enghouse Systems. Enghouse, again, is one of these really unloved stocks, but that I think its fundamentals are actually very, very strong. So very comfortable holding that one. And then I added a little bit of Canadian National Railway. This one is for sure going to struggle if this tariff situation persists, specifically because, they move all of these goods across Canada and US, including the car industry goods, which unfortunately is being tariffed right now. So that one may have more room to fall, though I think it is a resilient stock. So I added a bit of that. And then I added a little bit of that XEQT World ETF under $30. I thought that was a good price point. Now, shifting gears, if you recall, I had announced in my, I think, first episode of the year that I would be actually sharing my returns now that I've put everything into my little spreadsheet and I have it all ready to track. These are total returns, so I'm including dividends collected year to date, as well as the stock price. Basically took the stock price at the end of December and then compared, okay, what's the price now? How much is the return, etc. You get it? So sharing those returns in all transparency, weighted average, that means with the weights that I had as of end of December, I am down 3.95%. And as a simple average, so that's just average of all the stocks, I'm down 3.23%. So I am down, but not down by very much, actually, which isn't too bad. This compares favorably to my world ETF, which is down 5.83%, and compared to my S&P 500 ETF, which is down 11.49%. Now, it's quite interesting when you look at this number. 3.95, it seems kind of like, we're doing all right. But actually, if you look under the hood and you see the portfolio holdings, you'll see that it's really driven by a bunch of different extremes in the end, right? And here, I'm actually really witnessing the power that diversification brings to smooth over some of those returns, right? So in our worst position, we have Walt Disney Company down almost 24%. Then we have Teladoc down 20%, and Brookfield Corp down 18%. Brookfield by itself is the biggest contributor to my low return right now, simply because Brookfield is the largest weight. So the success of my portfolio, a big part of that will be tied to Brookfield's success or failure. And then among the best performers, we have Franco-Nevada up 37%, Kits up 28%, and Alibaba up 27%. And then Algonquin Power and Northland Power up 11 and 5% respectively. Now, what do you see here that's interesting? My top performing holdings year to date, number one, is a gold and precious metals company. no surprise when people are scared of whatever the United States is doing, or they think that the US currency is not going to be reliable anymore, they run to gold. My number 2, I'm still surprised. It is Kits. Kits is a small cap specialty retail company. I would have not expected them necessarily to do so well. Usually these small caps get really hurt in these moments of uncertainty. Not saying that the business is bad. The business is doing great. But I would have thought that market sentiment would be low, and it seems like it's not, so that's great. And then number 3 is Alibaba, which is a Chinese company. So as you can see, this diversification there brings an advantage. And then who would have known number 4 and number 5 are renewable energy companies, although Algonquin isn't anymore a pure play. Now it is a standard utility, but Northland Power is a renewable, and it's also up. So all of this is quite interesting to see here. Now I should add, I think I've been clear in that last episode where I first talked about returns, but I'll add this again. I do think that everything here should be taken with a grain of salt. Those returns move so much every day now. I think that will continue. And I also think returns don't matter very much over such short periods of time, like year to date. We're in April. This is just 4 months in. I think it's more interesting to see over, say, 10 or 20 years how a portfolio does. But in the short term, literally anything could happen. Perhaps we'll be down 50% next week. So yeah, take this with a grain of salt here. Anyway, yeah, this has been kind of my strategy and my thoughts right now. I think key takeaways: keep calm, stay rational, stay invested for the long term. I see some people who've completely exited stocks. I don't blame anyone who does that, but I think if you don't need the money for, say, the next 20 years, it's probably best to stay invested, or at least that's what I'm planning to do. And I will continue to, dollar cost average into some high-quality businesses that I like, that I consider resilient, with different revenue sources, ideally across different countries too, who have a credible plan, good management, and so on, and just keep it at that. That's my plan for now, and I'll continue to keep you updated. My friends, thank you so much for listening to Newcomer Investor Channel. As always, please feel free to give us a 5-star. Make sure to follow us on Twitter, and I'll catch you again soon.